Something extraordinary just happened in the precious metals market, and if you're not paying attention, you're about to miss the biggest financial signal of the decade. While everyone was glued to their screens watching silver bounce around $92, a government institution just made a move that changes everything. This isn't speculation. This isn't conspiracy. This is documented evidence that the system is breaking in real time, and the people who are supposed to maintain order just admitted they've lost control. Welcome to Finance Folder, where we decode the financial signals that Wall Street doesn't want you to see. If you're serious about protecting your wealth in these uncertain times, hit that subscribe button right now and smash the like button, because what I'm about to share with you is information that could reshape your entire investment strategy. Let's get into it. For the past 72 hours, the silver market has been absolute chaos. Traders have been watching the price whipsaw between $88 and $94, trying to make sense of the violent swings. Technical analysts have been drawing lines on charts. Talking heads on financial television have been debating whether the bull run is exhausted. But while everyone was distracted by the noise on the screen, something far more significant was happening behind closed doors. The United States Mint, the official government agency responsible for producing the nation's coins, just updated their internal pricing structure. And the numbers they published aren't just a routine adjustment. They're a confession that the entire pricing mechanism for silver has completely disconnected from reality. We've obtained confirmation that the Mint has now priced the proof American Silver Eagle at $173. The uncirculated version is listed at $169. Stop and think about that for a second. The spot price that everyone is watching on their trading platforms is $92. But the government entity that actually produces physical silver coins is pricing that same silver at $173. That's an $81 premium. That's nearly a 90% markup over spot. This isn't just unusual, this is unprecedented. And it tells us something terrifying about the real state of the precious metals market. Now, I can already hear the objections. Some people will say that the Mint always charges a premium. They'll say this is just normal markup for manufacturing and distribution. But that argument completely misses the point. Yes, the Mint has always charged premiums, but those premiums have historically ranged between 5 and 15% over spot. What we're seeing now is a premium that's approaching 100%. That's not a manufacturing cost. That's a market dislocation. That's the difference between the fantasy price on paper and the reality price for physical metal. And here's the detail that makes this even more significant. The Mint isn't even selling coins right now. Sales have been suspended for weeks because they can't keep up with demand. So why would a government agency that isn't currently selling anything go into their system and nearly double the listed price? They're doing it because they're preparing for what comes next. Think about the strategic calculation here. The Mint knows that when they eventually reopen sales, they cannot possibly sell silver at $92. If they tried to do that, they would be instantly overwhelmed. Every dealer in the country would place massive orders. Foreign buyers would flood the system. The Mint would be selling a strategic asset for pennies on the dollar, and they know it. So they're preemptively raising the price to $173, because that's where they believe the market clearing price actually exists. They're front-running reality. They're telling anyone who's paying attention that the $92 spot price is a complete fiction. It's a derivative mirage that has no connection to the actual cost of obtaining physical silver. This creates a bifurcated market structure that cannot sustain itself. On one side, you have the paper market. These are the futures contracts trading on the exchanges. These are the algorithmic traders buying and selling digital promises to deliver silver at some point in the future. They're operating in a world where silver is $92. On the other side, you have the physical market. These are the people who actually need to touch the metal. The industrial manufacturers who need silver for solar panels and electronics. The Mint that needs silver to produce coins. The sovereign wealth funds that want to hold tangible assets. These players exist in a completely different reality where silver costs $173 if you can even find it. When the gap between these two realities reaches $81, the market isn't discovering price anymore. It's discovering insolvency. Consider the psychological impact of this revelation. If you're an investor who owns physical silver and you see the government pricing that silver at $173, are you going to sell your holdings for $92? Obviously not. You're going to hold, you're going to wait, you're going to realize that your asset is worth substantially more than what the paper market is willing to acknowledge. This dynamic destroys the liquidity that the short sellers desperately need. The major banks that have sold massive quantities of silver futures contracts need physical holders to sell so they can cover their positions. But the Mint just told every silver owner in America that their metal is worth $173. They just created the ultimate incentive to hold rather than sell. They've accidentally weaponized the retail investor against the institutional short sellers. Let's examine the timing of this repricing, because timing is everything in financial markets. This price update happened on a Friday afternoon, immediately following an aggressive attempt to suppress the paper price. Throughout Thursday and early Friday, we saw massive selling pressure in the futures market. The price was driven down from $94 all the way to $87 in a matter of hours. The technical damage looked severe. It looked like the rally was broken. But by the close of trading on Friday, the price had recovered back above $90. The market closed the week at 90.14, marking the first weekly close above $90 in the entire history of silver trading. And within hours of that close, the Mint updated their pricing to $173. This isn't random. This is a direct response to the failed price suppression attempt. This is the physical market telling the paper market that the game is over. What we're witnessing is a war between two opposing forces. On one side, you have the deflationary pressure of the paper derivative market. These players want lower prices because lower prices protect the value of the dollar. Lower prices make their short positions profitable. Lower prices maintain the illusion that fiat currency is stable. On the other side, you have the inflationary reality of the physical commodity world. These players demand higher prices because higher prices reflect the true cost of production. Higher prices account for the depletion of easily accessible deposits. Higher prices reflect the collapse in purchasing power of the currency itself. By setting their price at $173, the United States Mint has chosen a side. They've aligned themselves with the physical inflation reality. They're admitting that the purchasing power of the dollar has deteriorated to the point where a single ounce of silver costs nearly 173 units of currency. This is what currency debasement looks like when it's actually happening. It's not a dramatic crash to zero. It's a series of sudden repricings where the cost of real assets jumps overnight to reflect the diminished value of the money. But the Mint's repricing was only the beginning of a much larger story that unfolded over the weekend. While the Mint was updating their website, something else was happening in the vaults that hold the physical silver backing the futures market. We've analyzed the daily warehouse reports from the CME group for Friday, January 16th. These reports are public information, but most people never look at them because they're usually boring. They typically show minor movements of metal, a few thousand ounces deposited here, a few thousand ounces withdrawn there, normal fluctuations. But Friday's report was anything but normal. Friday's report showed a systematic evacuation of physical silver on a scale that should terrify anyone who understands what it means. In a single 24-hour period, more than 4.1 million ounces of silver were physically withdrawn from the COMEX vault system. Let me give you context for how massive that number is. 4.1 million ounces equals approximately 127 metric tons of silver. This is not a jeweler buying supplies. This is not a collector purchasing coins. This is a fleet of armored vehicles. This is industrial scale logistics. This is the kind of movement that requires advanced planning and significant capital. And the withdrawals weren't concentrated in one vault. They were spread across every major custodian in the system. 1.3 million ounces were pulled from the Asahi depository. 1.1 million ounces came out of the CNT vault. Another 1.2 million ounces were withdrawn from JP Morgan's facility. And roughly 750,000 ounces were removed from Manfra, Tordella, and Brooks. This was a coordinated operation across the entire network. Now here's where this becomes absolutely damning. This massive withdrawal happened on the exact same day that the paper price was hammered down to $87. Do you believe in coincidences of that magnitude? Do you think it's an accident that the price dropped $5 right before 4 million ounces walked out the door? This was engineered. The price suppression on Thursday and Friday wasn't designed to make money on short positions. It was designed to provide cover for a massive physical withdrawal at a discount. If you're removing 4 million ounces of silver from the system, every dollar the price drops saves you $4 million on the settlement cost. They crashed the price specifically to loot the vault at a cheaper rate. This is market manipulation at a level that should trigger regulatory investigations, but it won't because the entities doing the manipulation are the same entities that hold massive influence over the regulatory system. But the total withdrawal number isn't even the most alarming data point in Friday's report. The truly frightening number is what happened to registered silver. In the COMEX system, there are two categories of metal. There's eligible silver, which is silver stored in the vaults but not available for delivery against futures contracts. And there's registered silver, which is metal that has a for sale sign on it. Registered silver is the inventory that can actually be delivered to futures contract holders who stand for delivery. It's the buffer that makes the entire futures market function. On Friday, the registered category collapsed by over 2.4 million ounces in a single day. It fell to just 119 million ounces. That's the thinnest registered inventory cushion we've seen in years. This means the owners of that metal, the banks and trading houses, are removing the for sale signs. They're converting registered metal to eligible status. They're taking it off the market. They're making it unavailable for delivery. Why would sophisticated financial institutions remove inventory from the market at the exact moment when prices are surging and demand is exploding? Why would they make metal unavailable for delivery when they could be selling it at record prices? Because they know something the public doesn't know yet. They know about policy changes that are coming. There are reports circulating that the incoming administration is preparing to classify silver as a critical strategic mineral. There's discussion of implementing Section 232 trade restrictions. If the United States government is about to declare silver strategically important and potentially restrict exports or implement price controls, you absolutely do not want your metal sitting in a public vault where it can be frozen or requisitioned. You want it moved to private storage, you want it offshore, you want it somewhere the government cannot easily access it. We have strong reason to believe that a significant portion of this 4 million ounce withdrawal is being shipped to London or Shanghai. The London Bullion Market Association is reportedly experiencing severe inventory stress. The arbitrage spread between Shanghai and London has been pulling metal eastward for months. The same dynamic that's draining New York is simultaneously draining London. The banks are engaged in a desperate game of musical chairs. They're pulling metal from COMEX to plug holes in London. They're borrowing from one market to cover shortfalls in another. But this strategy only works if there's enough metal to move around. And the data suggests there isn't. This transfer of physical inventory from public exchanges to private vaults is the end game of a market squeeze. When you see 4 million ounces exit the system in a single day, you're watching the liquidity of the market evaporate. You're watching the escape hatch close. This brings us back to the Mint's $173 price tag. The Mint understands that the vaults are being systematically drained. They know that if they attempted to purchase 4 million ounces of silver to manufacture coins, they couldn't source it at any price close to $92. The metal simply isn't available at that level. It's already been claimed by other buyers. So we now have a situation where the paper futures market claims silver is worth $92. But the physical inventory that supposedly backs those paper contracts is disappearing at a rate that mathematically guarantees a delivery failure at some point in the near future. If the COMEX continues to bleed registered inventory at 4 million ounces per day, the entire registered stockpile will be gone in less than 30 trading days. 30 days. That timeline takes us directly into March, which is historically one of the largest delivery months for silver futures contracts. The open interest data for March contracts indicates that traders are positioning for physical delivery in record numbers. They're not rolling their contracts forward. They're standing for delivery. They want metal now, not promises for metal later. But if the banks drain the vaults in January and February to ship metal overseas, what happens when March arrives and thousands of contract holders demand delivery? There won't be enough metal left to fulfill those obligations. This is the force majeure scenario that everyone in the precious metals community has been anticipating for years. It's the moment when the exchange has to declare that it cannot meet its delivery commitments. It's the moment when they tell contract holders that physical settlement is impossible and they'll be receiving cash settlement instead at whatever price the exchange deems fair. But industrial buyers don't want cash. They need actual silver for manufacturing. They can't run a solar panel factory with a check. They need the metal. So Friday's vault raid wasn't just a large transaction. It was a signal that the insiders are exiting the system while they still can. They're taking their chips off the table before the table collapses. For retail investors, this should be the loudest alarm bell imaginable. The banks are taking delivery. The government has suspended coin sales. The vaults are hemorrhaging metal. If the most sophisticated and well-informed players in the world are scrambling to secure physical silver and remove it from the public markets, why would any retail investor remain exposed through paper instruments? The great repricing isn't just about price increasing, it's about physical availability decreasing to zero. While the institutional players were raiding the vaults on Friday, the retail public was doing something equally historic on the other side of the market. We have data showing that retail investors have been net buyers of silver exchange-traded funds for 167 consecutive trading days. 167 days. That's more than 7 months of continuous accumulation without a single day of net selling. This is the longest buying streak ever recorded in the silver ETF market. In just the past 30 days, silver ETFs have absorbed over $900 million in new capital. The buying intensity is running at more than twice the 3-month average. To put this in perspective, the current buying pressure has now exceeded the peaks we saw during the 2021 Silver Squeeze event. Back then, it was a coordinated social media campaign. It was intense but brief. The buying lasted a few weeks and then faded. This time is completely different. This isn't a flash mob. This is a sustained migration of capital. This is money fleeing from overvalued stocks, fleeing from negative real yield bonds, and seeking protection in hard assets. But here's the tragic irony of this situation. This enormous wave of capital, nearly $1 billion in just 1 month, is flowing into the wrong instrument. The vast majority of this money is going into paper ETFs like SLV, the iShares Silver Trust. Retail investors believe that by purchasing shares of SLV, they're buying silver. They believe they're removing metal from the market and protecting themselves from currency debasement, but they're mistaken. When you buy a share of SLV, you are not buying a bar of silver. You are buying a claim on a fractional interest in a trust that holds silver in a vault controlled by JP Morgan. The same JP Morgan that we just watched withdraw over 1 million ounces from the COMEX vaults. The custodian of the ETF is simultaneously one of the largest short sellers in the silver derivatives market. This creates a conflict of interest so massive it should be illegal. The entity responsible for safeguarding the metal backing the ETF is also betting against the price of that metal in the derivatives market. This brings us to the true villains in this story, the major banking institutions that have constructed an enormous derivatives position that now threatens the entire financial system. We have credible reports indicating that major banks, specifically Bank of America and Citigroup, are carrying a derivatives book in precious metals that could represent as much as 4 billion ounces of gross short exposure. 4 billion ounces. Let's do the arithmetic. Global mine production of silver is approximately 800 million ounces per year. These institutions have sold paper contracts representing 5 years of total global production. They have sold silver that doesn't exist. They have sold silver that hasn't been discovered. They have sold silver that may never be mined. This is the textbook definition of a naked short position. And now they're trapped in a vice that's tightening from both directions. On one side, you have the retail buying wave pouring nearly $1 billion per month into the market, relentlessly pushing prices higher. On the other side, you have the institutional players draining physical inventory from the vaults, removing the collateral that's supposed to back the paper contracts. The banks are caught in the middle with a 4 billion ounce short position that becomes more catastrophic with every dollar the price rises. If silver reaches $100, the mark-to-market losses on a 4 billion ounce short position would exceed $400 billion. That's larger than the equity capital of most major banks. It would require a Federal Reserve intervention that would make the 2008 bailouts look modest by comparison. This explains the violence and desperation we're seeing in the price action. This explains why they smashed the price to $87 on Thursday despite overwhelming bullish sentiment. They're not trying to make money on these manipulations anymore. They're fighting for survival. But the retail swarm is relentless. 167 consecutive days of buying proves that the public is not intimidated by price drops. They're not selling the dips. They're buying the dips. Every time the banks engineer a sell-off to shake out weak hands, the ETF inflows actually accelerate. Retail investors see the lower prices as a better entry point. The banks are trying to scare people away, but they're only attracting more buyers at increasingly attractive prices. This is the unstoppable force meeting the immovable object. The unstoppable force is an inflation-fearing public that has lost faith in fiat currency. The immovable object is a banking system that's trapped in an insolvent derivatives position. Something has to break. And, based on the vault data we analyzed, the thing that's breaking is the physical inventory. The ETF structure provides a temporary buffer. It absorbs retail demand and keeps it separated from the physical market for a while. The authorized participants can use various accounting techniques and metal leasing arrangements to satisfy the ETF's requirements without actually moving physical bars. But they can't maintain this illusion forever. Eventually, the disparity becomes too extreme to hide. If SLV claims to hold 500 million ounces, but the actual metal has been shipped to China, the ETF structure implodes. We're approaching the threshold where the paper claims exceed the physical atoms by a ratio that triggers a systemic failure. For individual investors, this data should carry a stark warning. If you're part of that 167-day buying streak and you're holding shares of SLV or similar paper instruments, you're sitting in the danger zone. You're holding a receipt for an asset that's already been sold to someone else. When this squeeze finally breaks the banks, the ETFs will almost certainly be settled in cash rather than metal. They'll pay you dollars. But if you are buying silver to protect yourself from dollar debasement, receiving more dollars defeats the entire purpose of the investment. The retail swarm has the correct intuition. They understand that silver is valuable insurance against monetary chaos, but they're executing that intuition through the wrong vehicle. They're buying a map instead of the territory. This massive capital inflow proves that sentiment has fundamentally shifted. The public is waking up. They recognize that the dollar is being debased. They understand that official inflation statistics are lies, and they're voting with their capital. But they're casting those votes in a rigged system. The Friday vault raid was the smart money taking physical delivery before the ETF holders realized the metal is gone. So where does this leave us heading into Monday's market open? We have a situation where the spot price closed at $92. The Mint is pricing at $173. Shanghai is trading at a premium. And the banks are short 4 billion ounces against shrinking physical inventory. This is a powder keg. The retail buying pressure is the fuse, the vault drainage is the spark, and the explosion will be a violent repricing of silver to a level that reflects the actual supply-demand fundamentals. That level is not $92. It's not $100. In fact, based on the Mint's own admission, the real clearing price might be substantially higher than most analysts are currently predicting. We need to synthesize everything we've analyzed and arrive at a coherent conclusion. If you followed this investigation through to this point, you now possess information about the silver market that contradicts everything the mainstream financial media is telling you. You understand the sovereign signal, where the United States Mint revealed that the real price is $173. You understand the Friday evacuation, where 4.1 million ounces were removed from the vault system in a single day. And you understand the retail trap, where billions of dollars are flowing into paper ETFs while the physical metal disappears. The evidence is overwhelming. This is not theory. This is not speculation. This is a mathematical impossibility that can only be resolved through a massive price adjustment. Today is Saturday, January 17th, 2026, and we are staring at the largest pricing anomaly in modern financial history. Look at the numbers one final time. The spot price closed Friday at $92.14. The Shanghai Premium indicates physical metal is trading substantially higher in Asia. The United States Mint has priced silver at $173. The spread between the paper price in New York and the government price at the Mint is $81. That's not a normal premium. That's a chasm. That's a canyon of financial risk. If you can acquire silver for $92 that represents an asset the government values at $173, you're looking at a nearly 100% gain that's already locked in. You're buying dollars for 50 cents. But this dislocation cannot persist. Markets abhor vacuums. Economic forces demand equilibrium. There are only two possible ways this gap closes. Scenario 1, the Mint is wrong. The shortage is exaggerated. The 4 million ounces that left the vaults on Friday will return next week. Demand will collapse. The price will crash back toward $90. Given everything we've analyzed, the industrial demand that's inelastic, the mine depletion that's accelerating, the retail hoarding that's intensifying, this scenario is essentially impossible. The metal that left those vaults is not coming back. It's been shipped overseas. It's been moved to private storage. It's been taken off the market permanently. Scenario 2, the paper price on the exchanges gaps upward to meet the physical reality. This is the only plausible outcome. The paper price is always the last thing to adjust. The physical market leads. The premium markets confirm. And eventually, the futures market capitulates and reprices to reflect reality. We are setting up for a shock opening when markets resume trading. While exchanges are closed this weekend, news of the Mint's repricing is spreading through investment communities. News of the vault drainage is circulating on precious metals forums. Investors around the world are performing the same calculation we just completed. They're realizing that $92 is a gift. When Asian markets open Sunday evening and when New York opens Monday morning, we should expect to see a rush for liquidity. We should expect to see traders attempting to front-run the Mint's signal. If the government believes silver is worth $173, then $95 is cheap, $100 is cheap, $120 is cheap. This creates a buying panic that overwhelms the bank's price suppression algorithms. So what's the verdict after this exhaustive analysis? The verdict is that the great repricing has already begun. The era of double-digit silver prices is over in the real physical world, even if the paper markets haven't fully adjusted yet. The verdict is that the banks have lost control of the physical inventory, which means they've lost control of the price discovery mechanism. They can print infinite paper contracts, but they cannot print metal. And the verdict is that we are witnessing a massive wealth transfer from those who trust the screen price to those who trust the physical weight. This is the largest arbitrage opportunity in a generation, but it's also a trap for those who don't understand the difference between paper claims and physical possession. So what should your strategy be? How do you navigate this chaos without getting destroyed? Rule number 1. If you own physical silver, do not sell it. The temptation will be overwhelming. If silver spikes to $110 next week, you'll feel wealthy. You'll want to take profits. But remember the Mint's price. If you sell at $110, you're still selling at a $63 discount to the government's stated valuation. You're getting robbed. Do not exchange your scarce tangible asset for a depreciating fiat currency. Hold your physical metal until the paper price matches the real-world replacement cost. Rule number 2, ignore the volatility that's coming. The banks are wounded, but they still have weapons. They will attempt to engineer another price smash. They might try to drive the price back down to $88 to trigger stop losses and create panic. If you see a sharp sell-off on Monday or Tuesday, understand that it's a fake signal. It's a paper market manipulation. The real game is being played in the vaults, and the vaults are empty. Rule number 3, watch the spread between paper and physical prices. The most important chart right now is not the absolute price of silver. It's the difference between the spot price and the physical replacement cost. As long as that spread exists, as long as the mint is pricing higher than COMEX, the bull market is structurally intact. The squeeze is active. The moment that spread closes is the moment the repricing is complete. Until then, every dip is an opportunity. We are watching the collapse of a 50-year scheme to suppress the price of monetary metals through paper derivative manipulation. It's messy, it's violent, it's unprecedented. But it's also the opportunity of a lifetime for those who understand what's happening. The United States government just showed you their cards. They told you what they believe silver is actually worth. They published $173. Believe them. The banks are short 4 billion ounces. The mint has suspended sales. The vaults are being evacuated. And the paper price is still $92. The playbook is obvious. Before we close, if you found this analysis valuable, do me a favor. Subscribe to Finance Folder right now. Hit that like button. Share this video with anyone you know who's trying to navigate these insane markets. The information we're sharing here is not available on CNBC. It's not being discussed on Bloomberg. This is the real story behind the headlines, and the more people who understand it, the better. Thanks for watching Finance Folder, and I'll see you in the next one. Stay sharp out there.